Hello, family. Welcome to the third episode of The Roots of Money. This episode is about investments. We're going to talk about anything that you want to know about the stock market and the stock investing. So, I'm excited about this episode. Let's get down to it. All right. So, the first thing that you want to know is what is a stock market? What is a stock market? So a stock market is an avenue or venues or places where they regulate or they help companies to be publicly listed, where people buy and sell publicly listed companies. I will make an example of a couple of stock exchange. In South Africa, we have what we call JSE, Johannesburg Stock Exchange. So that's the biggest that we have in the country. The country can have more than one exchanges, by the way. So in the US, they have NASDAQ. They also have a New York Stock Exchange. They have New York Stock Exchange, and they also have NASDAQ. And then in Japan, they have Japan Stock Exchange. They also have Tokyo Stock Exchange. And of course, in every country, there is their own stock exchange where the companies from that country they get publicly listed, and then us as retail investors, we then of course, using different brokers or whatever broker that we want to use, we then buy those companies that are listed. So a stock exchange is a platform where we buy and sell stocks. That's basically what it is. And those companies that are there, there are those that are very small, there are those that are very big. The stock exchange is the one that puts them together, that profiles them, that gives us information about, the performance and whatever that is happening, in that stock exchange. So that's basically what it is in a nutshell. The second question is, why do companies get publicly listed? They get published for different reasons. Reason number one is to raise capital. Reason number two is for company development, to develop their products and services, to develop the company, operations, plannings, marketing, all the 360 aspect or components of the company. It's the reason why they want money from the investors, us as retail investors and institutions investors, of course. And then it is for growth. It is for also global recognition and status. The fact that the company is publicly listed online, it's a huge privilege, for the company. And then lastly, it is for debt reduction. They get money from investors and then they pay off their debts. In that way, they would then have more money that they distribute amongst, investors, and the company can rapidly grow because, they don't have much debt. So that's the reason why. The third question that people have is, why do you invest? Why do we invest as people? Why should we invest? Let me give you these four reasons. Number one, we invest because we want to make money. I know you were not expecting this one. Yes, we invest because we want to make money. But the real reason is we want to make money, with a high interest in returns. All right, so let me explain what are capital gains. Capital gains is when you are investing money on a company, let's say ShopRite, for 200 Rand, and then the company grows in value, it goes to 400 Rand, and then you withdraw that money, you sell the company, you sell ShopRite. That means you now have 400 Rand back. That means you have your initial 200 Rand as investment, and then you also have 200 Rand as a profit. However, you need to take into account the taxes that you need to pay from that. Normally, you pay a tax of roughly around 20% in South Africa. It differs, in other countries, but in South Africa, I do know that you pay 20%. And then you also have dividends. Dividends is money that is paid by a company. I normally call dividends as a thank you money. It's money that they just give you as an investor. How do you make money through dividends? The company make sales, they do their calculations, take out all their expenses, everything else that they need to pay for, and then they see that there is money that is left over that they can distribute amongst investors as per the number of shares that you own. So if you own 1,000 shares of that particular company, and the company has declared 2 rand per share, so it's 2 rand times 1,000 shares that you own. That's the amount of money that you're going to get. So that's how shares are, work, and that's how you make money through shares. The second reason why you are investing is because of ownership. You want to own the stock, you want to own the company, you want to be part of that company. If I want to be part of ShopRite, I can just buy their shares. Guess what? I'm now a shareholder of ShopRite. That's basically it. I want to be part of the team. I want to be part of people who are benefiting from ShopRite. I've probably seen ShopRite on billboard, on TV, and everywhere, and I wonder, if I want to invest in this company, how can I invest? This is exactly how you can invest, through stock market. All right, number 3, we invest because we want to beat inflation. Inflation is the biggest thing that you have in our economy system. So what is an inflation? Inflation is where things are just expensive. People can, buy certain things, or they can afford certain things. So there is not a lot of money circulating in the economy. Things are expensive. People are not borrowing money from the bank. Companies are suffering. People are getting, retrenched. It's just a mess. And in those situations, where the interest rate has gone up and people can't do much, they no longer afford the bread now because it's a bit expensive. It's crazy. So normally the inflation is around 3% to 6%. It fluctuates around there. And the stock market, it normally gives us the profits or the returns of at least 10% on a yearly basis. Per annual, we get at least, this is an average that is taken from S&P 500. Number 4, in terms of why people are investing, they invest to generate wealth and for generational wealth for their kids and their grandchildren. That's the reason why. Now let's move on. There are 3 types of stocks in terms of sizes. There is what we call penny stocks, which are small companies. They are very tiny, tiny in terms of the share price. And then we have medium companies. And then we also have large companies. We normally call them blue chips. Those are big companies, like your Meta, Facebook, or Apple, Tesla, and so forth. Those are big companies. We normally call them blue chips. And then small companies, there are companies that have a very small, share price. I'll explain now what do we look at in terms of gauging whether the company is big or small. What is a market cap? A market cap is market capitalization. It means it's what they look at to weigh the value of the company, the worthy of the company. They actually look at the market cap. So let me give you the breakdown in terms of prices. What do they look at? The small company, it's a company that has a market cap of 300 million to 2 billion. And then a medium company, or medium caps, it's a company that has 2 billion to 10 billion. And then the large cap is a company that has 10 billion to 100 billion. And then we have what we call mega caps, which is 100 billions to trillions. However, sometimes they don't put the mega, they just say large, and then large, then it involves all of them up to trillion. Some, they break it further down to mega companies. So that's how we know that the company is small or big. There is an advantage for 3 of them to buy small companies, medium company, and large company. Let me quickly explain them. The advantage of buying small companies is that they can still exponentially grow. They are still very young. They have a potential to exponentially grow. However, the downside is they are very vulnerable. They are not very experienced in the market, in the public domain. People do not know much about them. They don't sell that much shares on a daily basis, on a monthly basis, on a yearly basis. That's the only downside of it. But the upside is they can, grow exponentially because they're still very young. Think about a company that has, that sells for maybe a $2 or $5 or $10. Think about it, maybe in 10 years or 20 years it can sell for maybe $20, it can sell for $100. There is that room of growth or for growth. And then medium, they are balanced, they are stable now in the market. And then when you look at the large companies, the advantage is that they are big, they are well known, they are hugely traded on a daily basis. That's the upside. The downside is normally most of them, they grow steadily. They don't grow, exponentially or rapidly, because now they are big. They just maintain their status, they grow steadily, they don't really grow that exponentially. However, there are those companies that are massive, they're big, but they still do have that potential to grow rapidly. It depends on the sector, it depends on the company, it depends on the new acquisition. Maybe they just bought a new company and then it just shoot up, or something really happened in the company that just, boost the share price. But normally the big companies, they grow steadily, but those are the companies that are much trusted even in, difficult times. Even if, we are in recession, depression, whatever, those are the companies that we rely on because they are big, they are well known, their share price is stable, even their market cap is very big. And normally those companies, they have more money than debt normally. So those are companies that are quite big. However, I would advise you to at least have a representation of all of those companies. All right, let's move on. Let's talk about asset classes. What are asset classes? Asset classes are different type of assets to buy or to own. These are the asset class that you would find in the stock market. Please note that there are different terms that are used to, talk about shares. Sometimes they are called shares, sometimes they are called equities, sometimes they are called securities. You can choose any, but they mainly mean the one and the same thing, really. So number one, we have shares. Number two, we have ETFs. ETF stands for exchange traded funds. Number three, we have unit trusts. Number four, we have bonds. Number five, we have indexes or fund indexes. Number five, we have real estate. Number six, we have real estate investment trusts. Normally they're called REITs. And then number six, we have commodities. Commodities, it could be agricultural product, could be gold, silver, platinum, and so forth. All of those are called commodities. And then we also have cryptocurrency. It has entered the list. So all of those are asset classes. It is highly recommended that people invest for their retirement in the stock market. Why? Because stock market makes money, in a long term. If you invest for a long period of time, that's where you actually make a lot of money. If you understand what a compounding interest or how compounding interest works, this is exactly how compounding work. It works with, time. It works with, gaining interest over time. As you gain more money, you make more profit. So that's basically what it is. So it is highly recommended that you invest for your retirement. Not only for retirement, earlier on I spoke about investing for, generational wealth, for bigger goals, maybe buying a car, buying a house, renovating for your kids, or any other thing that you want to do. This is the best platform for you to start, putting money there and invest. All right, so how to invest? Where do you start? Number one, you start with a research. You need to research what you are doing. What is the stock market? You need to know the jargon. You need to understand the platforms that are used. You need to understand everything. You need to look at the people who are the playmakers. You need to look at the leaders in those sectors. You need to look at different markets, compare, contrast, and all of that. It starts with research and analysis. You start there. Number two, you need to find a broker, a reliable registered broker. Number three, you need to understand what is risk tolerant. Please invest the money that you are willing to lose. Number three, diversification. You need to understand that investing in the stock market relies on your diversification. You need to diversify based on different markets. I spoke about JSE, New York Stock Exchange, Tokyo, and all of that. you need to invest in different, avenues or stock exchange. That's number one. Number two, you need to invest in different industries. Number three, you need to invest in terms of different companies in terms of sizes. I spoke about that just now. And then also diversify in terms of asset classes, like how I mentioned all those asset classes. There has to be a balanced representation of all those asset classes. And then lastly, you need to do what is called technical analysis and fundamental analysis. It is very, very important for you to understand the companies that you are buying by doing a thorough research on them. There's so many things that you need to look at. You need to look at the finances of the company. You need to look at the management of the company, the internal issues, the external factors that might affect the company. There are so many things that you need to really look at for you to make a decision of buying a company. You don't just look at, social media of what people are saying and then just buy a company. There are so many factors that you need to look at for you to make a decision to buy a company. The company might work for me, but it may not necessarily work for you. Why? Because I'm maybe willing to wait for 5 years, 10 years. You are not willing to wait that long. Maybe you want to make money in 1 year or 2 years. In that way, you need a company that will at least give you those profits. You need to do a research. You will find companies that can give you, return in a short period of time. And for me, I need the returns maybe in 10 years, 20 years or so. All right, moving on. We want to look at dollar cost averaging. What is it? It's a strategy that is used to mitigate price risks. So basically, instead of putting 20,000 same time, you put 5,000 each. So you'd put 5,000 this week, 5,000 next week, 5,000 the other week, 5,000 that other week again. That way, the prices would be fluctuating. That would be a time where you would be paying really, really less money. There would be a time where you would pay more money. So the average would be what you are actually looking for. So there are times where we buy companies where they're like extremely high. The way to avoid this is to not buy that stock at the same time. Buy it, consistently. I would recommend people to buy stock every month. Every month you need to put something on the stock that you currently own. I don't encourage people to keep on adding new stocks every month. This month you have 5 stock that you're adding, that other month. No, no, no. It's about the value of the current stock you have. It's not about the number of stocks you have, but it's about how much in each stocks that you have. So if you have, 20,000 in 3 stocks, it's better than having 20,000 in 7 stocks or in 20 stocks. So the smaller the companies you have, the better. The only thing that matters is the amount of money that is in those companies. Remember, you make more money by adding more money in your stock. If you have more money, more profit, more interest, more, dividends that are coming your way. But if you just have maybe 1,000 rand in, 20 stocks, you're not going to make a lot of money, both from, the growth of the company and dividends. So dollar cost averaging helps you to buy shares, one at a time, consistently. That's what it is. All right, so let's look at the platforms that you can use to get the information that you need, to research the companies, to understand the companies, to evaluate and analyze them. So number one, it's Yahoo Finance. Yahoo Finance for me is the number one platform. It's my go-to platform. That's the first one. The second one is Google Finance. Yahoo Finance and Google Finance, they basically offer the same thing. What might be different is the interface or how they present information, but really most of the features, they are the same. It's just different companies really. And then number three, investing.com. I love it. You find a lot of information there, updated stuff, updated information. And then lastly, number four, in South Africa, you can look at MoneyWeb. It's a good platform also to, do your research and understand. I would recommend that you check in your country or in your province or in your city which website, provides relevant information, because you would find that some information is global, some information is local. So you want to find a bit of both. You want to find information, that is in your context. What is happening in South Africa? What is happening at ESCOM? What is happening, in this company, in that company? Whereas the global platforms, they don't cover some of the things, that are happening in our countries and all of that. So it's important to balance the website, balance the information. And lastly, please make use of the company's website. If you want to buy ShopRite, go to the ShopRite website and understand everything about them. Look at their documents, look at their updates, look at everything. That way it's going to help you. And lastly, the social media platforms. Look at their social media platform. Look at what people are saying about, everything that they do. Are they positive, feedback more than negative feedback? What's the balance there? Then make up your own decision. Last part of this podcast, we look at the broker. You need a broker for you to start investing. You can't invest directly, to these exchanges. You need a broker, so a middleman, a company, an investment company. I know banks do offer, the service to buy shares. I do also know, hedge funds companies, fintech companies, financial technology companies. There are so many investment companies that are out there that you can use, to buy shares. Just find the company that you can work on or work with. The only thing that you want to look at when you are finding the broker is the fees, the professionalism. Are they professional? Is the platform user friendly? You know, do they respond on time? What is their feedback if you have a problem? Do they have enough information about the stock market? Do they have the academy, side in their platform that teaches you so that you become better? It's important to find a broker that helps you, not just only wants your money, but also supports you in every way possible. So that's what I would look at if I want a broker. Another thing that you need to understand about brokers, they need to be registered, they need to be regulated or licensed to hold your money. Lastly, in this episode, please make sure that the broker you are choosing is registered, regulated, and licensed. They need to be registered as financial services provider. Every broker needs to have a registered number, a unique number to show that they are registered. You can take that number and go search whether that broker is registered or not. You can check under, the conduct authorities. In South Africa, we have what we call a financial sector conduct authority. When we shorten it, we say it's FSCA. So that's what you actually need to check, whether the company, is registered or not. So please make sure the company is registered as FSP. And then number two, they need to be registered as credit providers if they are providing credit. They need to be licensed as over-the-counter derivatives providers. That's what you need to look at in the company. Make sure that their website looks legit. You can call them, you can email them. They are real people, they are not brokers that are fly by night. All the best, guys, in your investment journey. There's still more to do. You still need to do a lot of research. If you can find a mentor that can mentor you, I certainly do mentor people, but there are many other mentors out there. Please do your thorough research before you start investing. But investing is for everyone, it's for all of us. You have to invest. I cannot overemphasize, the importance of investing. You have to invest. You have to invest. Thank you so much and all the best. I will see you on episode 4 of The Roots of Money. Cheers.